Let's dive into capital budgeting. It's a critical area of finance that every business professional should understand. Capital budgeting is the process businesses use to make big, long-term investment decisions. These are the kinds of decisions that can define a company's trajectory for years to come. These aren't your daily coffee runs. We're not talking about small, routine expenditures. Instead, we're talking about significant investments like buying new equipment, perhaps upgrading an entire production line, or launching entirely new products, which requires substantial upfront investment in research, development, and marketing, or even expanding operations, building new facilities, or entering new markets. These are all examples of capital budgeting decisions. Such decisions shape a company's future and involve significant amounts of money. We're talking about investments that can run into the millions or even billions of dollars. The benefits or losses from these investments play out over years, often spanning a decade or more. This long-term impact is what makes capital budgeting so critical. Given the scale and long-term nature of these investments, you need more than just a gut feeling to make the right call. Intuition alone isn't enough. That's where capital budgeting techniques come in. These techniques help managers systematically analyze different options and pick the best ones based on financial metrics and strategic alignment. Make a bad call, and you risk losing money, damaging your company's reputation, and missing better opportunities that could have generated significant returns. But smart choices, backed by solid analysis, can boost profits, drive revenue growth, and increase shareholder value. They can also open new markets, allowing your company to expand its reach and tap into new customer bases. Ultimately, effective capital budgeting can strengthen the business, making it more resilient and competitive in the long run. In essence, capital budgeting is about evaluating and selecting projects that will generate value for the company over the long term. These are projects whose returns stretch beyond a year, often extending for many years into the future. This requires careful forecasting and analysis of future cash flows. These decisions are costly, representing a significant commitment of resources. They're also hard to reverse once they've been set in motion. Changing course mid-project can be incredibly expensive and disruptive, and they lock in a company's direction for years, shaping its strategic priorities and competitive positioning. Get it right, and you build value, creating a foundation for sustainable growth and long-term success. Get it wrong, and you pay the price, potentially jeopardizing the company's financial health and future prospects. That's why understanding these tools is crucial for anyone involved in financial decision-making. It's essential for anyone interested in how businesses grow, innovate, and create value. It's about making informed choices, based on rigorous analysis and sound financial principles, not just hopeful guesses or wishful thinking. So let's dive deeper and see how these tools work in practice, exploring the key techniques and methodologies used in capital budgeting. Alright, let's dive into how quickly you can expect to see your cash back from an investment. We're going to start with a simple yet insightful metric: the payback period. It's a fundamental concept in finance, and understanding it is crucial for making informed investment decisions. The payback period is a straightforward way to gauge how quickly an investment essentially pays for itself. It's all about understanding the timeline until you break even. This is a critical factor for investors who are keen on minimizing risk and maximizing liquidity. In essence, it tells you how long it takes to recover your initial outlay, the money you initially put into the project or investment. Think of it as the countdown until you're back to square one, financially speaking. This recovery comes directly from the project's cash inflows, the money that the investment generates over time. The faster these inflows accumulate, the shorter your payback period will be. For example, let's say you invest $200,000 in a business venture, and that venture generates $50,000 per year in profit. In this scenario, your payback period is 4 years. It will take 4 years of $50,000 profits to equal your initial $200,000 investment. Simple, right? Now, what happens if cash flows vary from year to year? In that case, just add them up year by year until you reach your initial investment. So if you made $20,000 in year 1, $60,000 in year 2, and $70,000 in year 3, you'd need to make $50,000 in year 4 to reach your initial $200,000 investment. This method is particularly useful for a quick risk check, allowing you to quickly assess the viability of an investment. A shorter payback period means less time your money is tied up in the investment, reducing your exposure to potential risks and uncertainties. It's easy to calculate and understand, making it accessible to both seasoned investors and those just starting out. This ease of use makes it a popular first filter when evaluating potential investments. It helps narrow down the options and identify those that warrant further investigation. But here's the catch, and it's a significant one. The payback period ignores the time value of money, a fundamental principle in finance. A dollar today is worth more than a dollar tomorrow due to factors like inflation and the potential to earn interest or returns. But payback doesn't care about this crucial concept. It treats all dollars equally regardless of when they are received. Furthermore, it also ignores any cash flows that occur after you've recouped your initial investment. This means that a project that pays back quickly but then fizzles out later on might appear more attractive than one with significantly bigger long-term gains, even though the latter is ultimately a better investment. Therefore, use payback for a quick initial screen to get a general sense of the investment's timeline. But don't stop there, as it only provides a limited perspective. It's just one piece of the puzzle, and relying solely on it can lead to suboptimal investment decisions. Let's move on to explore more powerful tools that take into account the time value of money and provide a more comprehensive assessment of investment opportunities. Alright, let's move on to the big leagues. We're talking about the financial tool that separates the pros from the amateurs. It's time to bring out the heavy hitter, net present value, or NPV. This is where we really start to understand the true economic impact of a project. NPV asks a fundamental question. How much value, in today's dollars, will this project realistically add to the company? It's not just about making money, it's about creating wealth. It meticulously discounts all future cash flows, both positive and negative, back to the present, accounting for the time value of money, then subtracts the initial investment, the upfront cost required to get the project off the ground. This gives us a clear picture of the project's profitability. If the NPV is positive, meaning the present value of future cash inflows exceeds the initial investment, the project adds value to the company. Conversely, if it's negative, indicating that the initial investment outweighs the present value of future cash inflows, it destroys value and should be avoided. Let's illustrate with an example. Suppose you invest $10,000 today as your initial outlay, and in return you expect to get $5,000 in the first year, $4,000 in the second year, and $3,000 in the third year. So, you're getting returns over 3 years. Now let's discount these future cash flows at a rate of 10%, reflecting the opportunity cost of capital. Add up the present values of each of those future cash flows, and then subtract that initial $10,000 investment, and the result you get is your NPV. This single number tells you whether the project is expected to create or destroy value. The decision rule is remarkably simple. Accept projects with an NPV above zero. It's a clear, unambiguous signal. NPV considers all cash flows from the very beginning to the very end of the project's life. And crucially, it incorporates the time value of money, recognizing that a dollar today is worth more than a dollar tomorrow. This comprehensive approach is what makes it the gold standard for capital budgeting decisions. It gives you a clear dollar amount representing the value added to the firm, providing a concrete basis for decision-making. Unlike simpler methods like payback, which only focus on how quickly you recoup your initial investment, it doesn't ignore what happens after you get your money back. NPV takes a long-term view, considering all future cash flows. Because of its rigor and comprehensiveness, NPV is the go-to method for maximizing shareholder wealth and ensuring that investment decisions are aligned with the company's financial goals. Now, admittedly, it's a bit more math-heavy than some other methods, requiring a solid understanding of discounting and present value calculations, but the insight it provides is absolutely worth the effort. The clarity and accuracy of NPV are unparalleled. So if you want to know, with a high degree of confidence, if a project truly makes you richer in the long run, NPV is your definitive answer. It's the tool you need to make sound investment decisions. Now let's take a closer look and see how it stacks up against some of these other methods we've been discussing. Next up, we'll dive into IRR, the internal rate of return, another key metric in capital budgeting. Meet the internal rate of return, or IRR. IRR tells you the project's expected annual percentage return, the discount rate that makes NPV zero. It's like asking, what's the break-even rate of return for this investment? If IRR is above your required rate, the hurdle rate, accept the project. If not, reject it. For simple projects, you can solve for IRR directly. For complex ones, use Excel or a calculator. IRR is popular because it gives a percentage, easy to compare to loan rates or other investments. But IRR can be tricky. With odd cash flows, you might get multiple IRRs or none at all. It also assumes you can reinvest at the IRR, which isn't always realistic. Still, IRR is a useful check alongside NPV. Use it to see if a project clears your minimum return bar. But remember, NPV is usually the better guide for maximizing value. Let's look at another tool for when money is tight. Enter the Profitability Index, or PI, a great tool when you can't fund every good project. PI measures the value created per dollar invested, present value of inflows divided by initial investment. A PI above 1 means the project adds value, below 1, it destroys value. Use PI to rank projects when capital is limited. Pick those with the highest PI until your budget runs out. For example, a project with a PI of 1.3 gives you $1.30 in value for every $1 invested. PI is especially handy in capital rationing, helping you get the most out of your budget. It's a quick way to compare projects of different sizes. But remember, PI is a relative measure. NPV still tells you the total value added. Use both to make smart choices when funds are scarce. Now let's check out a simpler, accounting-based method. The simple rate of return, SRR, or accounting rate of return, looks at average annual profit as a percentage of investment. It's easy. Average annual profit divided by initial investment times 100%. For example, $10,000 average profit on a $200,000 project is a 5% SRR. SRR uses accounting profits, not cash flows, and ignores the time value of money. It's simple and uses familiar numbers, but not ideal for investment decisions. Different accounting methods can skew results. Use SRR for a quick check, but rely on cash flow-based methods for real decisions. Now let's see how these methods stack up. NPV and IRR usually agree. Positive NPV means IRR is above the discount rate. But for mutually exclusive projects, they can disagree, especially if projects differ in size or timing of cash flows. NPV is preferred because it measures total value added, which is the main goal. IRR can give multiple answers with odd cash flows, making it less reliable. NPV assumes reinvestment at the cost of capital. IRR assumes reinvestment at the IRR, which can be unrealistic. When in doubt, trust NPV for the best decision. Use IRR as a supplement, not a replacement. Understanding both helps you make smarter choices. Now, what if you can't fund every project? Capital rationing happens when you have more good projects than money to fund them. The goal shifts. Maximize total NPV within your budget, not just pick the biggest projects. PI shines here. Rank projects by PI and fund the highest until you run out of cash. If projects are indivisible or lumpy, you may need to test combinations to find the best fit. Sometimes a mix of projects with slightly lower PIs can yield a higher total NPV. PI is a great guide, but sometimes you need a bit more analysis. The key: get the most value from every dollar you invest. Let's wrap up with the big takeaways. Capital budgeting tools help businesses make smart, long-term investment decisions. Payback period is quick and simple, but ignores time value and later cash flows. NPV is the gold standard, measuring value added and accounting for time. IRR gives a percentage return, but can mislead with odd cash flows or reinvestment assumptions. PI is perfect for capital rationing, showing value per dollar invested. SRR is easy, but less reliable for real investment choices. Smart managers use a mix of these tools, with NPV as the main guide. The goal: make informed, value-boosting decisions for a stronger future.